One of the biggest mistakes real estate investors make is putting rental properties inside of an S corporation. Here's why. Hey taxpayers, it's Tiffany Gonzalez, CPA. Let's get into it. Many people place real estate in S-Corps, assuming it will save them money on taxes, especially since S corporations don't have self-employment tax. However, this reasoning is flawed because passive income isn't subject to self-employment tax in the first place. While S-Corps are pass-through entities, meaning they avoid double taxation at the corporate level, the expected tax benefits for rental properties rarely materialize. Ultimately, the disadvantages of holding real estate in an S-Corp often outweigh any perceived advantage. One of the major downsides of putting a rental property in an S-Corp is that S-Corps do not allow a step-up basis upon the owner's death. Let me explain to you why that's a big deal. Say you bought a rental property for $1 million in 1990. By 2025, it's worth $4 million. That means you have a $3 million gain. Normally, your heirs would get a step up in basis when you pass, meaning their new cost basis is $4 million, the fair market value. If they sell on the day you pass, they owe zero capital gains tax. But not if the property's in an S-Corp. Instead, your heirs would owe capital gains tax on the $3 million gain due within 6 months of your death. This is one of the ways the wealthy transfer wealth tax-free, step-up basis. And it's why you should avoid using an S-Corp for rental real estate. So let's say you've got your property in an S-Corp. What do you do next? If you need to remove it for reasons like refinancing, estate planning, restructuring your portfolio, or trying to get step-up basis someday, you need to know that it triggers a taxable event when you remove the property from your S-Corp. That means you owe taxes on it, even if you're just moving the asset to another entity that you own, like an LLC. If you were selling the property to someone else, it wouldn't be as much of an issue. But if you're just shifting assets to restructure your portfolio, the last thing you want is to pay a huge amount of tax on it. So you might be thinking to yourself, Tiffany, stop bringing me problems and start giving me what the solution is, right? This is what you might want to do instead. For most real estate investors, LLCs, limited liability companies, are a better option. They don't trigger taxable events when transferring properties in or out of them. They have step-up basis. There's more flexibility in relation to the ownership, and it's way easier to manage. Like S-Corps, LLCs also offer liability protection, but without the costly tax traps we just talked about.